Hello investors and traders. This video will explain the basics of the RSI indicator and how you use this technical indicator in your investing or trading strategy. The Relative Strength Index, RSI, is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other assets. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The indicator was originally developed by J. Wells Wilder Jr. and introduced in his seminal 1978 book, New Concepts in Technical Trading Systems. Traditional interpretation and usage of the RSI are the values of 70 or above indicate that a security is becoming overbought or overvalued and may be primed for a trend reversal or a corrective pullback in price. An RSI reading of 30 or below indicates an oversold or undervalued condition. Relative Strength Index is an oscillator. An oscillator is a technical analysis tool that constructs high and low bands between two extreme values and then builds a trend indicator that fluctuates within these bounds. Traders use the trend indicator to discover short-term overbought or oversold conditions. Again, the range for the RSI is 0 to 100. It is a very popular indicator which measures the velocity of price movement during trading. RSI is a popular indicator in technical analysis which has stood the test of time. It is easy to understand and to apply to any market or any time frame. This tool measures an oversold and overbought in the asset and can aid investors in spotting changes in market sentiment. This indicator should not be used alone, but is a good tool to build a rule-based weight of evidence strategy. Generally, when the RSI surpasses the horizontal 30 reference level, it is a bullish sign. And when it slides below the horizontal 70 reference level, it is a bearish sign. Put another way, one can interpret the RSI values of 70 or above indicate a security is becoming overbought or overvalued and may be primed for a trend reversal or a corrective price pullback. An RSI reading of 30 or below indicates an oversold or undervalued condition. The usual default settings is 14, but you can adjust the setting based on your trading or investing system. If you lower or decrease the length, RSI becomes more sensitive and you see more overbought and oversold. If you raise or increase the length, RSI becomes less sensitive and you see less overbought and oversold. Swing traders or medium-term traders usually use 14 length, while the short-term traders use 5 length. Choosing the right number depends on your trading style and system. Try testing with different setting lengths. Everything above the 70 line is considered overbought region. With the lower length numbers, you might want to raise the number higher to 80 or 90 on your line. Anything below the 30 line is considered the oversold region. With lower length numbers, you might want to lower your numbers to 20 or 10 on your line. So in perspective, when the RSI indicator touches the 30 line, it is cheap and the asset is considered expensive when touches the 70 line with a 14th length. Problem with RSI is if the trend is strong, it can remain overbought or oversold for a long period of time. Again, same as many technical indicators, you can not only base your strategy on one indicator, but a weight of evidence. Indicators are not magic. During trends, the RSI readings may fall into a band or range. During an uptrend, the RSI tends to stay above 30 and should frequently hit 70. During a downtrend, it is rare to see the RSI exceed 70 and the indicator frequently hits 30 or below. These guidelines can help determine trend strength and spot potential reversals. For example, if RSI can't reach 70 on a number of consecutive price swings during an uptrend, but then drops below 30, the trend has weakened and could be reversing lower. The opposite is true for a downtrend. If the downtrend is unable to reach 30 or below and then rallies above 70, that downtrend has weakened and could be reversing to the upside. Trend lines and moving averages are helpful tools to include when using the RSI in this way. A bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly lower lows in the price. This indicates rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs on the price. As you can see in the following chart, a bullish divergence was identified when the RSI formed higher lows as the price formed lower lows. This was a valid signal, but divergences can be rare when a stock is in a stable long-term trend. Using flexible oversold or overbought readings will help identify more potential signals. RSI Swing Rejections. Another trading technique examines the RSI's behavior when it is re-emerging from overbought or oversold territory. This signal is called a bullish swing rejection and has four parts. The RSI falls into oversold territory. The RSI crosses back above 30%. The RSI forms another dip without crossing back into oversold territory. The RSI then breaks its most recent high. As you can see in the following chart, the RSI indicator was oversold, broke up through 30%, and formed the rejection low that triggered the signal when it bounced higher. Using the RSI in this way is very similar to drawing trend lines on a price chart. Like divergences, there is a bearish version of the swing rejection signal that looks like a mirror image of the bullish version. A bearish swing rejection also has four parts. The RSI rises into overbought territory. The RSI crosses back below 70%. The RSI forms another high without crossing back into overbought territory. The RSI then breaks its most recent low. The following chart illustrates the bearish swing rejection signal. As with most trading techniques, this signal will be most reliable when it conforms to prevailing long-term trend. Bearish signals during downtrends are less likely to generate false alarms. Key takeaways for the RSI. First, look at the RSI on different time periods: 5, 10, 14. The common default setting is usually 14. I have seen people use 5 in their strategies with success, and also 10. So play around with time periods for you. 2. I have seen extreme levels of RSI going back 3 to 4 years to be very helpful for oversold and overbought levels. 3. I've reiterated many times, one indicator does not make a system. Many indicators combined make a system. RSI is a great indicator to use. So let's talk some strategies. Imagine combining the RSI at the 70 and 30 level with a MACD. This is a common strategy used. Imagine combining the CCH or the OBV with the RSI. This is what is called rule-based trading. You have a system. What about using RSI going into resistance or support? RSI with a bias towards the buy side. There are many interpretations of how to use the RSI. Many systems and software programs are based on some tweaks to the relative strength index. RSI can give you an entry and an exit point. Learning to implement and recognize RSI signals will assist you in your investment plan. If you find this video helpful, please follow Insight of Investing. The next videos of interest could be other indicators or further in-depth analysis of RSI. Good luck on your journey. Study it, analyze it, adapt it. Peace.